few understand exactly what's going on with this financial and banking crisis and how markets will react in April and May. But Michael Gayed does. Michael Gayed is the portfolio manager of the Tidal Financial Group and the publisher of the award-winning Lead Leg report. He's going to be sharing with us his projections for the upcoming month and the indicators he's using to make these projections. Michael, welcome to my show. Thank you for being here.
You understand how well you've been doing, by the way. You are absolutely killing it on YouTube and with these interviews, man. If you understand just how damn good you are.
Thank you. All right, well, let's start with some recent news coming out of May 24th, Friday. We're speaking on Friday. Deutsche Bank shares fell overnight as much as 14% today on the session before trimming losses. This came in as their credit default swaps rose alongside with fears that the bank would collapse, basically. Is this fear irrational, as some analysts have said? This is just the market behaving irrationally, or is this a legitimate fear?
Well, I mean, I think the problem is this is like everybody falling for availability heuristic, right? Which is that everyone's automatically thinking it's like 2008. Listen, throughout February, I was repeatedly tweeting in a very ominous way, March, because the indicators that I follow were suggesting that you might have high volatility in March, right? Suddenly the banking, in quotes, crisis happens. You got a very sudden scare, right? The headlines look horrendous. And I kept on saying repeatedly that I don't think this is the credit event, which I expect at some point this year, that this isn't just something that results in a lot of wild gyrations. Volatility works both ways, both up and down. And that point about, people that say to me, well, it sounds like being flippant about just how serious this situation is. To your point, what's happening with Deutsche Bank and this kind of rolling series of where to focus the short attention on, it is very serious, actually. This is worse than 2008 from a financial crisis perspective if you play it out to the logical conclusion, which is why you can't bet on it, because leverage is so much higher than 2008. So they had to step in to secure the depositors. They had to do it very quickly. It was very clear. FDIC, the Fed, the Treasury, they came out with that press release. Now there's a lot of back and forth as to what's going to happen next. But I have to tell you, I always go back to, it's often the thing which you don't focus on, which surprises the markets the most. It's now very, very obvious that there's serious financial strain, but the market really hasn't gone anywhere. I mean, small caps have gotten hurt, regional banks have gotten hurt, large cap growth is nearly at new highs. All the money rotated out of banks into technology. So while it's serious, and we can talk about Deutsche Bank as well, I don't think it's anywhere near as cataclysmic as the narrative out there makes it out to be. Now, having said that, I do think, since we're recording this on March 24th, I do think actually next week in particular could be a very high risk week. And I say that purely because all the indicators that have been saying that the crisis isn't here are now starting to all flip to say risk off. So we'll see. March is not over. The volatility is not over. There could still be another big VIX spike coming in the next several days.
I do want to talk about your indicators. You've tweeted about this as well. But going back to your point about this not being as cataclysmic as some may believe, well, you did say this is worse than 2008. So the
problem with betting on the end of the world is you're not going to get paid for it, right? It's so serious that you can't bet on it. Just like, by the way, this is one of the reasons I was arguing for a melt-up. The conditions were there for a melt-up October 2nd when everybody was screaming, fire. The bond market volatility was so high and yields were rising so fast that you would have had mortgage rates at 20% by November. You can't bet on that because that's a system reset. It's the same dynamic. It's the same argument here. It's just a different type of system reset. In this case, if you play it out to the logical conclusion, banking crisis, run of the banks, faster speed with which people can remove their deposits from banks, then what are we even doing talking about the banking crisis? Might as well learn how to grow food.
Well, okay, so that aside, you said that the banking crisis is not the sole cause of this market volatility, or at least is not the sole cause of the volatility we're about to see. You made this tweet on the 23rd of March. I'm just going to read it. April is high risk for stock market correction in the context of a melt up. Lumber agrees today it's getting crushed as gold sends a warning. If a correction happens in April, it's not driven by banks, it's something else. That's how this works. What is it driven by then?
This is the thing. I'll tell you after it happens, right? Because the reality is the narrative follows price, right? But here's what I would say. I think there's a few things which are being underappreciated.
You're like HBO. You're like HBO. You keep people right. You keep people on the edge. You don't give away all the spoilers. But yeah.
Well, because I don't know, right? I don't know the mile marker. I might crash my car, but I know I need to slow down when it's raining, right? That's why I always go back to conditions first and foremost. So first of all, the banking crisis is solvable because all they have to do is secure the deposits. Okay, done. Right, at least for now, that's done. Okay, and everything is too big to fail. I mean, at the end of the day, if it comes down to it, the entire world will just be J.P. Morgan Chase, and that's it. Right. So I think that's in quotes fixable given the money printer. But I think there are other dynamics that are happening. If you look at REITs have gotten smoked the last several weeks. There are a lot of very smart people that argue that we're on the verge of a commercial real estate crisis. Okay, maybe it's that. There's a lot of people, I think, that would correctly note that oil prices and commodities in the way they've sold off could be a precursor to a credit event because a lot of high yield junk debt issuers are very leveraged miners and producers and drillers, right? My point in saying this is that it's never the obvious to focus on. So it's kind of like, here's the bird. Everyone's talking about the banking crisis. The market hasn't really responded. If you're going to have another bout of high volatility, which I think is going to happen in April, where directionally the market will go down, you could have a legitimate correction there, which would be risk off. Flight to safety trade is back. Thankfully, that's a good thing for my own funds because treasuries are now responding counter to equity volatility. Then that could be sort of where the bears win for a moment in time. But this is the thing that people are not understanding. You can be bullish and bearish at the same time. So I believe we're in a melt-up scenario because we're in a pre-election year. I put out that tweet, got a lot of engagement. I said, yeah, pre-election years are historically the best year of the presidential cycle, right? The strongest S&P stock market returns historically happen in pre-election years. The theory there is, well, the existing party wants to stay in power. The president wants to stay in power. So what do? They stimulate. So how do you stimulate the economy with high inflation? With a manufactured bank crisis. Which, by the way, if you haven't noticed the balance sheet of the Fed, stimulus is now happening. The pre-election dynamic is there. So I do think you have a melt-up. It could be a volatile one that surprises a lot of people by year-end.
Why is it a manufactured bank crisis? What does that mean?
This is all known. People are making it seem like this is just suddenly out of nowhere. Credit Suisse has been failing since 2008. You look at a chart, it's been straight down, right? I mean, even with Silicon Valley Bank, the regulators knew it was in trouble. I mean, all this is now coming out now. It's not like this is like out of the blue. The timing, sure, you can say it's out of the blue, but that's what happens when you go through the fastest rate hike cycle in history.
Well, I believe a lot of big fund managers have owned Credit Suisse, not only stocks but bonds. PIMCO, I believe, being one of them, over $100 million per fund of worthless Credit Suisse bonds. I don't think they knew, Michael. Otherwise, they wouldn't have held them.
No. I would disagree. I think you can know that the dynamics are poor, but you don't necessarily know exactly when something's going to hit.
I see.
I mean, that would be kind of my point. And there's that great saying when it comes to markets: nothing matters until it matters, and then when it matters, it's the only thing that matters. Right? That's, I think, what largely explains Credit Suisse. But again, it's like these dynamics have been in place for a while. And again, I go back to, yes, the financial sector has gotten crushed. Yes, small caps have gotten crushed. But if it's a true risk-off period, every sector would collapse, and that is not the case for now.
Who manufactured this crisis?
I'm not a conspiracy theorist, but I do believe that sometimes timing is a little too coincidental. Like I said, the fact that this is happening early in a pre-election year to justify some form of stimulus puts us in the playbook, right? So I don't know. I mean, look, people might roll their eyes when I say that, and I'm not a conspiracy theorist by any means, but it's manufactured in the sense that, the headlines make it seem so horrendous, but we're down 3% off the highs for the S&P since this started. It doesn't make sense to me. The narrative is manufactured, I think, is probably the better way to frame it.
I understand. So, but you're saying that there may be stimulus on the way?
There is stimulus now. I mean, a bailout is stimulus.
Oh, okay.
Right, pumping money. I mean, if you look at the balance sheet of the Federal Reserve, I mean, basically, Jim Bianco put out this tweet. It's like, I think it was 2/3 of quantitative tightening has been undone because of this, in quotes, crisis. This is how you get stimulus and high inflation.
Let's talk about your stock market correction call. The lumber to gold ratio your lumber to gold ratio has historically been quite accurate in predicting moves. What is the ratio telling us now?
Yeah, and as I always say, conditions, not calls. So the conditions are there. It's not just lumber to gold here, which has broken down quite a bit, especially the last couple of days here. But utilities against the market also tends to be a leading indicator of high volatility risk-off dynamics. The fact that treasuries have been showing that flight to safety dynamic, I think, is very important. So in my world, I have 3 funds. They all use different signals. They're all trying to get to the same place as far as risk-off dynamics. Typically, when you have a real risk-off, high volatility, high-risk juncture where there might be a correction, all the signals will line up. Those signals will be utilities against the market, long duration treasuries against intermediate, and then lumber to gold. All of them are now saying, be careful. Now, it's interesting that it's happening now in the context of a bank crisis, which is probably largely priced in, and the market largely not really responding that badly in terms of the headline averages. So maybe it's a false signal, maybe not, but this is what markets tend to do. They suck in the bulls and frustrate the bears until the bears capitulate, in which case the bears, had they just stayed a little bit longer, would have been right for a moment in time.
For those of us watching right now who may not have seen our prior discussions, what is the lumber to gold ratio exactly? How does that work? And what is the logic behind using that as a signal?
So it's actually very straightforward, right? Average home has 16,000 board feet of lumber. If you believe housing is a leading indicator of the economy, of credit creation, contraction, as lumber goes, so too does housing starts, construction. So lumber is a leading indicator just from the effect of the housing market and construction. Gold, which by the way looks like it wants to finally break out of a decade-long period of nothingness. Gold is a safe haven play, meaning historically when you have high volatility, when you have risk-off periods like treasuries, like the dollar, like utilities, it tends to be a beneficiary of high risk conditions for equities. Now, it is interesting, right? Because the dollar was the risk off play last year, clearly. Treasuries were not. Historically, treasuries tend to be the best. Treasuries failed miserably. Treasuries are coming back as a safe haven play. My Phoenix Rising Giphies on Twitter, or Giphies, however you pronounce it. But now it seems like gold is actually the real beneficiary, right? And you're seeing clearly there's money that's positioning into gold. Maybe the banking in quotes crisis is the catalyst for that, but regardless, as I said, gold is sending a warning, and the fact that gold has been this strong in the context of what looks like a resilient S&P should give everybody a little bit of pause in terms of the path with which the market continues to move.
So the lumber price has been coming down over the last couple of weeks. Well, year to date, it's down. Gold has done the exact opposite, like you just described. So the ratio, the lumber to gold ratio, has contracted. Is this an indicator for a correction, or is this a contrarian indicator for a melt up? How do you read this?
So it depends on the extreme level, right? It's kind of like it's a trend versus mean reversion. So risk on, risk off is ultimately about volatility, not direction, right? So now there's a link between direction and volatility, meaning in high volatility for equities, you tend to be in a downtrend or in a down period, but not always, right? I think that given the way that all of these signals that I'm known for, that by the way, I use in my funds, it's not me just saying it. I launch funds around these ideas. The fact that they're all kind of saying approximately the same thing at this point in the sequence makes me think that now it's not just a question of volatility. It's going to be a question of direction, right? And again, I go back to, I don't think it's going to be from the banking side. I think it could be something that really comes out of left field that nobody's talking about. And I don't know what that is, but if you have me back on your show, and by the time you have me back on your show, you'll have 100,000 YouTube subscribers because you're killing it, then we can talk about it then.
I want to know how severe this correction in April is going to be. I know you're going to tell me this in May, but
yeah, you know me well, David. That's exactly what I'm going to say. I have no clue. I'll let you know in May. I don't. It's hard to tell because there is this really remarkable differential between large caps and small caps, and obviously a large part of that is the regional banks and the financials. But you can make an intermarket analysis argument that there should be a closing of the gap of growth versus value, given how severe value underperformed, financials underperformed against tech, that there'd be a catch down, right, in certain areas of the marketplace. So for the headline averages, it could actually be pretty sizable. I don't know what number, but sizable to me would be 5-10% in a matter of a couple of weeks, which is basically what happened to small caps, right? But in this case, it would happen to large caps. But I could also be totally wrong on this, right? I go back to arguing that you could have a high risk juncture directionally in April does not mean you're not still in a broader melt up because we're in a pre-election year.
Pre-election year aside, I know historically, like you said, pre-election years have done quite well, but the Federal Reserve has engaged in monetary policy that has not really been seen before. They have been raising rates. Some argue they're going to pause rates now, but there's still quantitative tightening going on in the background. So they're pausing, tightening. How's this going to affect markets?
Well, I mean, that's the thing. They're not tightening anymore, right? I mean, just given the way the balance sheet has kind of spiked, they may want to go back to tightening. I think good luck. I put out a tweet. I think it was October of last year. I said I think a year from now, meaning in October of 2022, it'll be very clear the Fed already over tightens. By the way, that tweet is not to pat myself on the back, but it's spot on. Why am I saying that in the context of now? Why is this regional bank stuff happening? because they already over tightened, because there's a lag between when they tighten and then the effects, right? Now, by the way, there's another interesting dynamic here, which I think plays into April. You always have to think about things from the perspective of where's the fat pitch? Right? Where's the area where you can get some real outsized convex type of movement, where it's very clear there's a contrarian trade to be had? You look at the speculative short positioning on treasuries, even despite this move the last 2 weeks here, there is so much bearishness on treasury prices, meaning betting on rising yields by speculators, that you can clearly make an argument that there's going to be almost an engineered short squeeze. Push treasury prices up, push yield lower on the duration side. Now, by the way, that's one way to fix the banking crisis, right? Because to the extent that a lot of this is driven by collateral that got destroyed because of rates rising at the speed they were rising, how do you fill that asset value gap against liabilities? You make the safe collateral, which is treasuries, worth more, right? So you have this really interesting dynamic, I'd argue, where the hedge funds and the speculators have made a killing shorting treasuries. As a result, the banks have gotten killed. Now the banks now have to be saved. So what do? You flip the pain from the banks to the hedge funds.
Well, let me just ask you this. You're a financial expert. People are going to ask you probably in your personal life too, are you taking your money out of your bank right now? Are you worried that you're going to lose all your deposits in your checking and savings account?
Thankfully, I don't have that much money. So it's not much I can pull out because I'm invested in my own funds, right? Anyway, just from as an entrepreneur and somebody that's believing in what I'm trying to do and put out there. But it is interesting. I had somebody who was like a college friend I hadn't heard from in probably a decade suddenly text me saying, what I know we haven't talked in a while, but I'm nervous. What do you think I should do? I didn't respond, right? Because it's like, at least take me out before you ask me a financial question. But the broader point is that the fact that there was that kind of a fear made me actually very confident that I shouldn't have to worry so far about whatever cash I have in the bank, because the reality is, if people are that nervous, again, I go back to that's like end of the world. So who cares if you pull money out from the banking system? The entire system collapses with how much leverage there is. Instead of spending time pulling money out of the bank, again, let me actually buy guns and butter, because that's a system reset. It's Armageddon. You can't bet on it.
Let's close off on some macro themes. We spoke a while ago, and you talked about the four horsemen of the apocalypse: famine, war, plague. What am I missing?
Death.
Okay.
The big one.
Yeah, we haven't had death yet, but we've had all three. Okay. Now, are these themes behind us for good? Inflation's come down, right? That's a big one.
I'm pretty sure death remains just a truism.
Death is coming
in general.
All eventually, yeah. But
that's a truth. But no, look, I always go back to, it's not about anything except incentives. Those in power want to stay in power. Okay, so to stay in power, they create crises that they end up fixing and then take credit for. Politicians get voted in based on nominal, not based on real, because voters can't necessarily tell the difference. So there's no incentive by anybody that's in power, if you believe they want to stay in power, to let anything fall apart. Right. So the answer to your question is on the four horsemen. They've got snipers, right, to take the horsemen out because they want to stay in their cushy jobs. The elites don't want the system to break because it hurts them the most.
But do you think that the macro risks that we've seen over the last 2 years are still with us today, or perhaps there are new risks that we have to be aware of?
Yeah, no, I think the real risk, which goes back to the sort of the path of how this plays out. You could have a melt up followed by a credit event, and I don't think this is it. I keep going back to my core thesis around this is you have a lot of loans that were taken out at very low rates because of all the stimulus post-COVID. A lot of them mature on the corporate loan side in 2024, 2025. So most crises are refinancing crises, right? It's when they roll over that debt into higher rates where it becomes a problem. So you're going to have this kind of tsunami of debt that ends up getting rolled over next year into higher rates. Now, that could be a problem. A lot of these zombie companies may not be able to survive that higher interest expense. If I'm right on that it happens next year, the stock market and bond market needs to respond off of it this year, later in the year, right? That's where I think a credit event can happen, a VIX spike that could really flush out and end the bear market, officially. It's very possible you hit nominal new highs. Real new highs, I think, are going to be really challenging for the market for some time.
So asset allocation, then how are you positioned going into April, May?
Listen, I mean, the most important dynamic here is that treasuries are responding again, and gold, right? That you have options. The only option you had last year was really to go long the dollar. That was it. Okay, yeah, okay, you could have shorted short. Most people are not asset allocation was shorting. That's not an asset allocation, right? Type of position. So now, if you're going to say to yourself, I'm nervous about markets, even if you believe in the pre-election year cycle, as I do, I'm nervous about markets. What do? Yeah, asset allocation wise, it makes sense to go into treasuries. It makes sense to go into gold, not as financial advice, but just as from the standpoint of historically, these areas tend to be diversifiers. Right? I mean, this is the year where finally I think we have reset what diversification means. Right? Last year, everything was basically concentrated in the same way. The hell that I kept on referencing with equities and treasuries. This year seems to be some degree of normalization so far, and that's really, really positive, even though volatility makes it seem like it's not.
Finally, where can we learn about you and your work? You're killing it too. I mean, you've got 740,000 Twitter followers. How did that happen? I know you've been running your Twitter Spaces. Everyone needs to check that out. I'll put a link down in the description.
I've been told they're all bots because clearly I make money from bots. As somebody who's a portfolio manager, I clearly get assets, in my funds from zeros and ones that are bots. No, I mean Twitter, the lead lag report itself, which is separate from my funds, my premium research, YouTube. Yeah. And I'm serious for everybody that's listening to this that is not subscribed to this channel. No BS here. David's among the best. I'm not trying to say he's not paying me to say this. Click the subscribe button for him.
Thank you.
Show some support to him.
I appreciate it. Yeah, subscribe to this channel. Subscribe to Michael Guyette's channel as well. Very good discussions there. So yeah, we'll look forward to keeping tabs on your work and on your lead leg report. Thank you for joining me today. Appreciate your time, Michael. I'll have you back on soon to go over what's happened in April.
Yeah, and we'll do that in May. That's what we'll do.
All right, take care for now, and thank you for watching.